Hey guys, Frank here and welcome back to the New Vision channel where we talk about all things real estate. Now our goal with this channel is about learning and sharing sound principles of starting and growing a viable real estate business or any other business for that matter. In this video, we continue the series on real estate bookkeeping. And some of the things we are going to share in this video assumes that you are familiar with previous videos. If you are new to the channel, you can follow the preceding videos in the playlists shown. In part 7 of this video series, we introduced the topic of financial reports for your business. Specifically, that there are 3 main reports that you would want to understand in order to properly assess the health of your business. These were the income or profit and loss report, the cash flow report, and the balance sheet report. These 3 reports assess different aspects of your business and work together to tell a comprehensive story about the health of the business, so that you or any other interested party, such as a lender or an investor, can make sound judgments about the state of the business. Much like in school, these reports have the same effect. When they are good, you are able to grow and progress to the next level. When they are poor, you might be stuck in and struggle at the same level, or worse, kicked out altogether for poor performance. As an entrepreneur or investor, it is in your interest that these reports tell a good financial story about your business. In this video, we are going to dig a little deeper into the income report. When we meet someone, we often ask the following questions, by way of introduction or just for the purpose of small talk. What is your name? And what do you do? Although not often asked, the next logical set of questions in this sequence would be, why do you do what you do? In other words, your purpose. And finally, how good are you in doing what you do anyway? If one were to ask you these 4 questions about your business, you would answer the first by giving the name of your business, the second by saying you are in real estate business or whatever business you are in. And question number 3 establishes the financial purpose of your business, which is to make a profit. This happens to be the case with most businesses. Question number 4 establishes how good your business is in reaching that profit-making purpose that you desire for the business. This is where the income or P&L report comes in. The income statement is a reflection of the efficiency of your business in achieving its stated mission of turning out a profit. Great businesses are usually excellent profit-making engines, and poor businesses struggle to do so. The first thing to note about the income report is that it covers a period of time, usually a month, a quarter, or a year. And for whatever period you decide to run the income report, you start by taking a measure of the income that came into the business during this period. If yours is a real estate rental business, this would be mostly rents paid over that period. But it could also include other sources of income, such as late fees, etc., which we will just call other income. If you are running a different type of business, income would be whatever your customers are paying you for the goods or services that your business provides. Now that we have the income for the stated period, the next point of focus on the income report is the expenses for that same period. In the case of the real estate rental business, this would all be expenses that we categorize and explained in part 2 of this series. They include advertising, auto and travel, cleaning and maintenance, insurance, legal and other fees, mortgage interest, repairs, supplies, taxes, utilities, etc. Please note that your categorization of the types of income and expenses might be different from those stated here, especially if you are in a different type of business. Now that we have both the income and expenses for the period, the income report usually concludes by subtracting or deducting the expenses from the income. And what is left over is the net income or net earnings. If it is positive, it is called a profit, and if it is negative, it is called a loss. Hence, the name Profit and Loss Report. As a business owner, when you wind up with a profit for the business in the period, you are happy because your business is meeting its expected purpose. The only other question is whether the profit level is meeting the expectations that you had for the business. If on the other hand, you wind up with a loss, that is usually an indication that something is not working well in your business. And it could be any number of things. Your rents may be too low, or you are not collecting the rents as you should, or you're not doing a good job of managing your expenses. Whatever the cause, your job as a business owner is to find it and fix it. Otherwise, you might be on your way out of business. We will conclude by cautioning that while a loss in business is always a bad thing, ironically, an excess of profit might also be a sign of poor judgment in this case. It might be a sign that you are cutting too many corners when it comes to your expenses. That is, you may not be taking very good care of your buildings, and this will show up as a problem in the future. To understand this concept, check out our video on being penny wise and pound foolish. In the next video, we will look at the cash flow report and how it differs from the income report. Please let us know in the comments below if you find this type of content helpful. You would be encouraging us to create more by clicking the like button and subscribing to our channel. And while you're at it, please click that notification button so that you will immediately know when we put out new content. Many thanks, and see you in the next video.